Please take your seats. The program will begin in 5 minutes. Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. Please welcome to the stage Bloomberg's Lisa Mateo.
Thank you. I get applause. I love that. And a woo. That's even better. Good afternoon, everyone. Welcome to Bloomberg's The Future Investor, Finding the Opportunities. And I think that's the key word for today is opportunity, right? Because with so much volatility in the market, from a new administration to geopolitical concerns, how are and where are companies and investors finding those opportunities? Now, I have to admit, I am a glass half full kind of person, but as a reporter in this news flow, it has been tough. But we are going to find that silver lining for today. So you're going to be hearing from a number of business executives who will talk about their strategies for finding long-term profitability, right, for accelerating growth. You'll also hear from investors and what they get excited about when it comes to products, services, sectors, find out where they're investing. So we have a lot going on for today. We are just scratching the surface for today. If you're joining us here from Chicago, thank you for coming out here for today. If you're joining us, we also have people tuning in from the live stream. Thank you, too. We are so excited to have you for this 2025 portion of our Future Investor Series. Now, before we get started, I do have a couple of announcements. First off, thank you to our sponsor, Invesco QQQ. You'll be hearing from them in just a few moments, and they'll be sharing their insights on the stage for today. Also, ask questions. It makes my job and every other moderator's job easier. The way you do it is you scan the QR code on your table, write in your question. We'll try our very best to get it answered on the stage here for today. And for those of you who are on social media, hashtag the future investor. Can't forget about that, right? If you post anything, if some insight you saw for today, you heard from today, if you post any pictures, be sure to tag us, hashtag the future investor, and tag us over at Bloomberg Live as well. And be sure to give us a follow there. All right, without further ado, it is time for our opening remarks. Please welcome to the stage Paul Schroeder, QQQ, Equity Product Strategist with Invesco.
Thank you very much, Lisa, and welcome everyone here this afternoon. Very glad that you're able to join us here. As Lisa mentioned, my name is Paul Schroeder, and I'm the Equity Product Strategist for Invesco QQQ. And welcome to the Future Investor event. We're very proud to partner with an industry leader like Bloomberg to bring you very timely content that I think is very relevant for today's investors. You know, we partner with Bloomberg on several different events. You know, last week we partnered with Bloomberg at their key market event in New York, Bloomberg Invest. We also will be partnering with them in June for Bloomberg Tech, so I hope to see some of you there as well. But we've also done a lot of these smaller local events all over the country, and we've gotten a lot of really great feedback on the type of content that Bloomberg and Invesco has been able to bring. You know, for today, we're bringing several executives from industry-leading companies that will be discussing long-term drivers of growth along with return. So, you know, from a Q's perspective, you know, the things that really have been driving those sort of factors within the fund, we believe are the company's ability to really innovate throughout time and stay relevant. Obviously, with where the market is today and how volatile things are, I find this sort of content really helpful, as I tend to get caught up in the day-to-day, intraday market action. Today, another very good example of that. So having this sort of content where you're able to hear from these executives to talk about what their long-term focus and goals are fantastic. So more from the Qs later, but again, thank you very much for attending, and we'll move on with the show. Thank you.
So we are talking the drivers of return. So here to tell us more about it, we have Sean Barber from Macys, Jane Kern from JLL. Thank you guys for joining us. Jane, I want to start with you. Now, you're the global head of HR operations at JLL. Set the scene for us as far as the corporate world, right? There's a lot going on. There's return to office. There's new AI technology, so much you're dealing with. What is the mood amongst your employees? You know, what are they happy about? What are they concerned about? Because I'm sure this is a question that you ask them.
Yes. And thanks for having me today.
Sure.
I think our employees are excited about the future, but also a little bit reserved. I'm proud that I work at an organization that is tech leading and putting a lot of investment in tech and AI. So I think that's something that's engaging our employees because they want to stay relevant, be relevant, and have future skills. I think that a concern is always just this unpredictable market that we're in that seems to be forever. You know, there's geopolitical issues and things of that nature. So I think we try to help them focus on what they can control and the impact that they can have, and you know, all the other things that are going around the globe. You know, just stay focused on our clients and what you can contribute, and hopefully it'll all work out.
Excellent. Now, Sean, you're the Senior Vice President of Supply Chain for Macys. So I feel like I have to start with that elephant in the room, tariffs. Okay, we have to go there and start there. But Macys has managed disruptions in the past. So how are you handling this differently, or maybe not? So.
Yeah, it's an interesting question. It's certainly an interesting time. We joke that we feel like we've been through every type of potential disruption over the past 4 to 5 years that one could imagine. But seemingly every year we come up with a new one. So I think what we've done over the past couple of years is really harden the supply chain. We've introduced a significant amount of adaptability and anticipation into the supply chain. So we have found that really relying on and building on the relationships we have with our providers, whether those are suppliers or manufacturers, providers of transportation, so on and so forth, have allowed us to continue to adapt and pivot as necessary. We don't know what the next potential disruption will be, but we feel like we've got a pretty good idea of how to ebb and flow the supply chain and flex as needed.
Now, that goes kind of hand in hand. We had a question before from the audience that was, do you think tariffs could influence onshoring of manufacturing? Why or why not?
Yeah, it's a great question. I think what we will likely continue to see, at least for our purposes, is we've had a fairly dynamic approach to where we source from. You know, we have adjusted the places and the suppliers that we work with based on whether it's disruption, tariff articulation, so on and so forth. So I think what we're likely to see is we will continue to remain dynamic. We will make adjustments to our network as necessary, and whether that is onshoring or nearshoring or whatever it may be, I think we'll remain flexible.
Excellent. And Jane, the key to workforce optimization, how are you leveraging technology to find that efficiency within the organization?
Yeah, I think what's changed, I mean, I've been in the workforce a long time, and each economic downturn, this one feels the most shift, at least that I've seen in our organization, that you want to come out of this with not another like hiring spike and then another downturn. So I think we're really, really focused on operational excellence, and that the old way of growing was really, well, we need to hire more people. We must hire more people. That's the only way we can generate more revenue. And I think that that's totally changing now. It's, yes, we have a huge sales force and we have a great team out there meeting our clients' needs, but what are we doing to make sure that, you know, for example, I'm in human resources. Well, we generate a lot of value. We don't generate revenue. So how can I make sure that there's not waste in the HR system? How can I make sure that I'm not adding, you know, my team's busy, let's add headcount. And my team knows, don't ask me for headcount, because I'm going to ask you what's broken. What part of your process is causing your team pain or anxiety or feeling like they need more help? Because we're going to fix that process before I'm going to say, let's add more headcount. So I think that's what's changing, is just the dedication. You know, these, after each economic cycle, say you boom back up, like, and then it's like the next one comes. So why don't you get focused on really good process, and that you can ride the ups and downs with the team you have versus, you know, keep going back to growth through headcount.
And John, when we spoke earlier before, you said something interesting. You said everyone is becoming a supply chain expert in a way. You know, me, where's my package? Like everyone wants to know. But what kind of managing that nowadays, what does that look like?
Yeah, it's become a topic, right? Before
Of course.
it was kind of something that you just assumed worked well. And in the pandemic and in the recent years, everybody's become an expert. You're at home, you're tracking your orders, when is it going to show up, so on and so forth. And I think a lot of what's been accomplished through the past couple of years is that visibility has actually been rather positive. I think supply chain has reached a level of fluency and prominence in conversations that historically perhaps it was kind of something that was secondary or tertiary. So what I've seen is that it's actually pressed us to get better. You know, it's the need for adaptability, agility, yes, speed, but also flexibility. So in a lot of ways, the fluency that most consumers have built over the past couple of years in terms of where's my package, where's my order, what options make sense for me, has actually been really good in terms of pushing the broader supply chain forward.
Now, how have you improved performance, accuracy, inventory?
Yeah, it's a challenge to get faster, right? There are certain things that you can do simply. You can fulfill faster, you can adjust your delivery networks, you can work with new partners, so on and so forth. But you also have to get more sophisticated in terms of how you allocate inventory. And for us, we have a significantly changing breadth of assortment that every year a large portion of that assortment is something we have never bought before and we will never buy again. And so we are trying to anticipate and understand how demand is going to materialize, not just for a shirt, a sport coat, shoes, so on and so forth. So we've had to grow more sophisticated in terms of our ability to adapt and bring in demand sensing so that we better allocate inventory across the breadth of our fulfillment network and our stores. And we do our best to iterate and get better, but you'll never get it quite right. So we have advanced our capabilities to forward deploy a portion of our inventory, then bring in the demand sensing and understand how well demand is actually materializing against our plan, and then fill in based on when demand is actually occurring.
Now, Jane, you spoke earlier about your employees and the mood amongst employees, but you also recruit talent. So talk about the today's job market, because, for example, there's economic data out, right? Today we heard job openings higher, but the overall has talked about this slowdown in the labor market. So what are you seeing?
Well, I think like if anyone else has a family member out there or friend that's in the job market, it's really tough right now. And it is confusing because you're like, but wait, the job market report comes out every Friday, the first Friday of every month. So, and I obviously read it extensively. And for the last year, actually 5 years, it's all about healthcare. So if you are a nurse or a skilled trades professional, things of that nature, what do we call like stand-up jobs, deskless workers, those are in high demand. There are not enough nurses, there are not enough teachers, there are not enough skilled trades workers to fill the vacancies. Where you have an oversupply and you see people not really landing jobs would be in tech, marketing, HR, places that have maybe stagnated. And most importantly, people aren't quitting. So when you came out of the pandemic, 21, 22, it was a hockey stick. I mean, at one point, there were over 300,000 recruiter openings. I can distinctly remember that post. There were more recruiter openings than there were like software engineers. You'll never see that again. You will never, like my recruiting team is healthy and great, but I'm like, we won't be hiring recruiters for a long time. Not that we're not hiring, we're hiring, but our systems are getting so much faster and recruitment's right for automation that you can speed things up. So those are just some things that we're seeing in the labor market that if you're doing stand-up work, there's plenty of opportunities. There's still probably 3-to-1 job opportunities for you. But if you're doing sit-down work, knowledge work, people aren't quitting, which means there's not openings, there's no churn happening. So an example I have is my sister worked at Target for 15 years in marketing, was recently laid off, and I mean, months and months and months, and finally had to take a contract job. So there just aren't the jobs plentiful. So if the last time you were in the labor market was after that cycle where there were, it was the great resignation, and now you're back in the market, you're like, well, what happened? And it's the whole world changed. I don't know if it'll ever go back with AI coming. It's really companies are trying to figure out how will we grow, where will we grow, and you just don't have that AI impact with a lot of those stand-up jobs, nurses, skilled trades workers. It's just not impacting that group.
Yeah, AI is changing a lot. And I want to get into that in just a bit too. Sean, as far as now we talk supply chain, so let's talk demand. You work with different analytics technology capabilities when it comes to improving that. So take us through it, from the ports to the buyers to the consumer, how it looks.
Yeah, I think one of the things that we really landed on was that a lot of the challenges in managing an end-to-end value chain came from gaps in visibility, and it really came from a propensity of people to have to come up with opinions or perspective because there was an absence of fact where it was available. So one of the things that we really focused on was understanding where there were gaps in information in the value chain and understanding where people will have to come up with perspective. So we started to basically eliminate the need for formulating an opinion, and we started to knock down the places where there are gaps. So you mentioned a couple of them, but what we looked at was we looked at the areas where data was available but was not being made to good use. So we started developing a series of tools that basically increased the level of transparency and predictability of what was going to happen in terms of inventory flow. So taking into pieces of information like what was happening at origin ports, what type of delays were we seeing, what were ocean transits looking like versus what they were planned to be, what type of delay or backlog were we seeing at domestic ports, so on and so forth. So we brought all of these different factors in, and then we started to build the intelligence and the modeling to give a projection of when something was going to arrive all the way down to the PO and item level. The reason that we did this was that we thought that we could eliminate the concern or the potential what if, and we can use all the different data sources that were available to actually come up with a fairly high degree of confidence in terms of when our inventory was likely to land. That information is extremely available and valuable to our partners, particularly our merchants, our stores, our digital teams, so on and so forth, because they don't have to guess. They know. They have almost certainty in terms of when product is going to be available, and that goes into what type of promotions are we running, how do we think about our assortment, so on and so forth. So it's really about making do with all the information that's available and finding a way to effectively synthesize large data sets to make it useful in terms of insights.
You want to take the guesswork out.
That's right.
Exactly. So Jane, you talked about today's job market and what it looks like. What are you looking for as far as talent? I was reading an article, I don't know if it was yesterday or today, my days get confused all over the place, but it was saying how AI is becoming more of a conversation in the interview process. You know, you're asking more, what's your involvement with it? Talk a little bit about that and what else you look for in talent.
Yeah, I mean, I think right now you're really looking for curious people. Curious and resilient, to me, are the two things that I most often am trying to decipher during an interview. Curious around AI, like, do they work for an organization that is progressive enough to be investing in AI technology for their employees to use? That's important to me. If they're working for a company that hasn't made that investment, then what are they doing themselves to maybe use AI to plan vacations or write memos, or, you know, where is their curiosity thinking about being having future-ready skills, either enabled by their current organization or that they're curious enough to figure out how to make it part of their daily life. And then resilient. I mean, I'd say, and I'm sure this is many companies, if you don't like change, you're not going to enjoy working here, because we're always changing. We're a professional service firm, so we've got to be doing things better and faster and more innovative than our customers will, or, you know, why wouldn't they, you know, give us their business? So I really champion change and really reward folks that, you know, I say, you know, you want to be a leading edge. You want to be out there driving change and not resisting it.
And Sean, I'm going to bring you into this conversation because I hear you have a knack for finding talent. What do you look for?
I love what Jane said. I think curiosity is certainly one of the prominent skills that we look for. I mean, intelligence goes without saying, but there's a lot of different types of intelligence. I think what we find when we look for talent and the talent that's successful with our organization, you know, curiosity goes a long way. The intelligence is paramount. The resilience, I think, is also a great point. But it's the communication skills. It's the ability to go in, to gain entry to a conversation, to learn from those that are experts without raising an alarm or why are you asking me these questions. So that healthy curiosity, but the way to do it, it's not threatening, right? It's inviting. And then being able to synthesize that information in a way that they can communicate all the way from somebody that is fulfilling an order all the way up to our CEO walking through one of our fulfillment centers with us. So I think we look for kind of those dynamic, curious, highly communicative people that can be dangerous really anywhere you put them. It's not necessarily based on their background or their expertise. They can be very effective and fluent in a broad spectrum.
Yeah. Can I say two things to that?
Yeah, sure.
We have like two mantras on my team. It's progress over perfection. Yeah. So if you're a perfectionist, I'm like, you're not going to like working here. Yeah. And two, high energy, low maintenance. I said that's what you should pride yourself on. Be high energy, low maintenance, to your point, and be able to do many different things in different departments.
I love that. As far as the recruiting process, so we talked about AI. How is that changing the recruiting process? I'm sure there's good points to it, but I'm sure there's also the other side to it. I mean, you hear stories of people using AI to do resumes, to create their resumes, or they're using AI during a video interview, you know, to give them the answers to the questions. I mean, all these, you can't keep up with it. So how is it changing the recruiting process?
Well, I'll start with the good parts first.
Yes, please.
The good parts are that ultimately we should all be hiring for skills and not pedigree. Like, we should be figuring out what are the skills that we need for the longevity of our organization, and not just does somebody know how to do VLOOKUPs in Excel, right? Like, separate what can you teach and what can't you teach. And that's going to be the big part of recruitment. But in recruiting, it's further along than many other functions when it comes to AI. So we've invested in a lot of tools that keep the human in the loop but speed up the process. We hire from the boiler room to the boardroom, and I need the process to move quickly at certain levels to make sure that we meet our clients' needs. So we're adding a lot of AI to help the recruiter find the right candidate and then re-engage them. So when you are in recruiting, one person gets the job. If you had 100 applicants, 99 didn't. So we're in the business of no. But what we're trying to do is every time you get eyeballs on a rec and somebody applies, that's their time, and that's a fee to, or it costs us to get them to apply. So we're using AI to re-engage. So you have all these applicants. We have 1.5 million people that apply to our 30,000 hires a year. So we're trying to make sure that we've invested in that 1.5 million that have taken the time to fill out our application. Just because they didn't get that job doesn't mean they can't get the next job. So you're just trying to constantly re-engage your candidate base and keep them excited and hopefully hires and good brand ambassadors. The bad actors, I don't think HR or recruiting professionals have totally figured out how to take or negate the bad parts of AI, right? I mean, so that all resumes will start to look the same. They'll fake assessments and you won't know that till they start. So I think that we haven't balanced the bad part with the good part yet. And I think it's just going to be a matter of keeping ahead and learning and figuring out what you can do to make sure that it's used for good and not for bad.
All right. And Sean, I want to bring it to you for automation. How has that helped with fulfilling demand? How has automation helped with that?
Yeah, I think what we've seen is, there is this topic of AI, and so much is being bundled under AI. We've all become experts in terms of how to search or ask questions or write resumes or even answer interview questions, right, which is kind of interesting to watch. We've seen automation in a number of places. Certainly automation in terms of robotics. We have implemented a significant amount of robotics over the past couple of years. That automation is really serving a number of purposes. For us, it is increasing our ability to have storage density and throughput density. So that's our ability to get faster in terms of how we fulfill demand and how we hold inventory. And we're also seeing advancements in demand sensing. So automation that is bringing in a number of disparate sources, internal and external, and trying to synthesize them together to provide a more useful perspective and enrich how we're allocating and how we're making our buying decisions. The one limitation that I would say broadly we see is that foundational data is absolutely paramount before you can benefit truly from automation. It's almost like we're at a place where the tools are so interesting and their prospects are so rich that we're leaping towards those technologies while we're not necessarily addressing the foundational data capabilities that are necessary to take advantage of automation. So I think what we're going to see in supply chain is AI is going to continue to play a greater role in time, but there's going to be a need for technology and providers that are able to integrate all of the legacy automation, the legacy demand signals, the legacy software with what's coming next. And today, I would say that's a bit of a gap. Okay.
In the last few moments we have, looking ahead, I want you to speak to Jane about where the future of work is headed, and then for Sean, where the future of retail is headed. Jane, you can go first.
Yeah, I mean, I think we will continue to expand and learn how AI can be a part of our daily work. I do think it's all about tech-enabled processes and keeping humans in the loop. You will continue to find ways to bring this new advent of technology into what we do, and it will reshape jobs. We're working very hard right now to say, okay, our investment in AI will affect what jobs? Okay, so what are the skills? We don't want it, like I said, going back to hiring and laying off. We want to figure out, okay, if that's going to affect that group of people, how can we retrain them to go do something else? So I think that's what we're focused on, is just skills, the evolution of skills, and moving people to where the work is versus saying, your time's up.
Perfect. And we have about 30 seconds left. So
I'll do it quickly. I think retail is going to look a lot like what we've seen in terms of disruption. I think it's going to be ever-changing. I think we've seen that pure e-commerce growth has slowed down. It's almost normalizing. So I think we're rapidly approaching a place where it's going to be all channels. And I think where it's going to be paramount is the connectivity with the customer, the understanding of what she or he is looking for, and that adaptability and flexibility to be, whether it's in a store, it's at the doorstep, it's at a locker, so on and so forth. So I think flexibility and anticipation is going to be what separates strong retailers from those that are behind.
Excellent, guys. Thank you so much. Up next, we have a conversation with Jeff Long from Molson Coors. Thank you. Thank you, sir. Thank you. All right, we're going to keep going. Okay, so we're talking about strategies for accelerating growth. But before we get to that, I want you to kind of set the tone about the beverage industry itself, because we've heard so many stories about, people are drinking less, right? GLP-1 drugs, or maybe the Surgeon General warnings. Where do you see the industry headed? How would you describe it?
Well, I mean, the good news is this is what I get to do every day, is think about and understand these things. So I'm excited to get the chance to talk to you guys about it. I mean, despite what was a really noisy year last year in the industry, we ended the year about the same as we did before. So there's, systematic things associated with things like calendar changes and holiday changes, and those things kind of move around. But there's a lot of other things that are happening around it. And you mentioned one of them with GLP-1, and it's certainly be naive to say, oh, that has no impact, because certainly we know that has an impact on consumers. But I think something really powerful to sink our teeth into, if you look across generations from Boomer to Gen X to Gen Z to Millennial, about the same amount of them are drinking. It's about 60%. And that's the same generation to generation. If you look at what's different, it's occasions. And when you think about occasions, what that's saying is, I got a lot of choices. There's a lot of things in my mind. There's a lot of things I can pick, and there's a lot of things driving my choices. And so in those moments where they have the opportunity, do they pick up our products as much? And so as you think about our ambition to be a beverage company, and you think about what needs we're trying to meet for consumers, that's our primary ambition, is to show up with something relevant, whether it's an innovation, whether it's a core beer brand, whether it's something new like a Fever Tree that's new to our portfolio that meets the needs in those occasions. So that's the big opportunity.
And are you getting into non-alcoholic a little bit more? Do you see that?
Yeah, absolutely. Yeah, I mean, we've certainly seen that grow for the last few years, and that's absolutely part of the consumer choice. And so some of our big brands now have non-alc versions. And then when we think beyond just core beer with non-alc, there's things like non-alc adjacent, where a Fever Tree fits in, primarily a mixer, but a non-alc drink as well. And then things that are further away with energy drinks with ZOA.
Energy drinks, right? I forgot about that whole portion for you. Okay, so you lead the America's Commercial Accelerator.
Yeah.
You say that's key to the business in Americas. So how so?
Yeah, I mean, I think one of the things that we are really excited about is we get to say things like we lead the strategic growth of the business. And what that means, I mean, it starts with that occasion piece that I talked about. But what it means is we look across all the capabilities that support our marketing and sales teams in a way that says, how are we thinking forward? And for us, that thinking forward is centered really in this idea about category first. It means category first means that, our job is to think about, how do I be the best strategic partner with my retail customer? How do I think about making it really easy for a distributor to get the products on shelf? And how do I think differently about engaging with a drinker today and the drinker of the future? Because a lot of things are changing, so I have to think about how to evolve to meet those needs.
Okay, so dig more into this. So how are you accomplishing this?
From a consumer standpoint, or just the broader approach?
The broader approach.
Well, when you think about it, I mentioned three big buckets. So the idea of being category first, I think, is a real differentiating factor in our industry, right? There's certainly, a bunch of different ways to approach it. But in our mind, if we can lead for the category first, then that helps grow the overall size of the business. It helps us along the way as well. So think about it from a retailer perspective. Our job is to be the best strategic partner for our retail customers. We have a proprietary category management framework, and I won't talk about all the details of it here, but if you think about the core of that, it's that same idea of occasions. I just mentioned it a second ago. I mean, some people would have you believe that a consumer shows up to a grocery store or convenience store and they just buy the easiest thing, or the first thing they see. And our argument is actually they show up with a whole lot of purpose. Who am I going to be with? What are we going to do? What is the most relevant thing for me in this moment? And if I look for those relevant things in that moment, then I'm looking for a certain set of things. And that connection to occasion translates all the way down to how you think about innovation. We have a strong history of innovation with really strong innovation brands, but we haven't always made those as relevant as possible in the channel. So if you think about how that shows up differently for like a convenience store channel, where singles or flavor are really ruling the growth for convenience, are we finding a way to intersect what a consumer wants with what the channel needs and show up with the right products in those moments? So this year we'll have a big lean in with innovation for the C-store channel, which is a big opportunity of growth for us.
Now, you mentioned convenience stores. So is that a big portion of your business? correct?
Yeah, I mean, convenience stores is the biggest channel in beer for sure. And the challenge with convenience stores is it's just so different from the landscape of the retailer makeup, independent, you know, mom and pop, localized retailers and then big chain retailers. So for us, when we think about a channel like convenience, I mentioned innovation. So it's making sure that what you're producing really shows up and meets the needs of the shoppers in those moments. But you're also talking about new and different ways to reach a shopper. So we're not long, you know, hasn't been long for us to say something like pre-shop. Pre-shop used to be about like, do I have the right out-of-home really close to a convenience store? So when you're driving to go get gas, you see an out-of-home board, and you're like, oh, that's what I want. But think about the age of technology and integration in consumers and shoppers' lives. I mean, now pre-shop is reaching them on their couch when they're thinking about leaving, or reaching them in a moment where they are having an impulse buy or buying something else and you want to add beer to that moment. And so we call that sort of the moments that matter, and those are different by channel. How do you show up to be the most relevant in all those opportunities to influence, and that helps you connect in that occasion front.
So we talked about the retailers, convenience stores. Now, what about the consumer? How does this category, you know, first approach help with the consumer?
Yeah, we already heard Gen Z, I think, from the stage already. I mean, the conversation about Gen Z is an interesting one. I started this by saying one of the great foundational things for us, that's something we really anchor to, is that they're still engaging in the category at the same rate. The difference is in how to reach them, both, you know, how connected they are, the moments of technology and how you can find those connections, but also understanding deeply who they are and what motivates them. So this, you know, over the past several years, we've participated in sort of landmark studies to really understand needs, what consumers are after and what they're looking for. But we've extended that beyond. In the past, we would have talked about things like just understanding, and then we try to turn it into action. Now we want to understand and learn from them along the way. So how do we take that engagement with them and continue it so that when you learn something from them, you can also re-engage with them on how to think about packaging or a new liquid or a new product that's really new and emerging, and that you just want to understand what they think of it. So we've extended our insights with Gen Z from understanding into how do we work with them to activate.
Now, what do they want? I mean, what are they looking for?
Yeah, I mean, obviously there's a ton of interesting differences generation to generation in terms of, you know, what motivates people. And I don't know that it's so different from this generation to the millennial generation. We've seen a lot of changes over time. I think what you learn is that it's just about being more specific in how you find the ways to engage with them and what you think is available to them. So one of the things beyond things like GLP-1 is just the availability of alternatives. We talked about core beer. We talked about non-alc, which is a big emerging space. Sure. You're also talking about things like functional beverages and ready-to-drink spirits-based beverages. So there's just lots of things out there. And so I think understanding how to make that connection with them and find ways to do it in a really authentic way. But beyond that, I think they care about a lot of things we all care about, looking for value. Value takes on a different definition now, though. I mean, value once upon a time might have just been the price on the shelf, but, you know, value now might be how I feel like the packet or how I feel like the product resonates with me. Does it speak to me? Does it speak to a value that I share? Does it offer value in some other way? Like it feels aspirational, feels more premium, feels like something I'd like to hold in my hand. And so I think a lot of those things are similar. It's the nuance of how they show up for sure.
Now, I wanted to talk about tariffs for a bit, because we had a question from the audience. It says, how should we evaluate the supply chain's resilience given the possibility of new tariffs? It seems like it's been stabilizing post-COVID, but should we prepare for another major disruption? So how are you looking at tariffs when it comes to Molson Coors?
Yeah, I mean, you think about it, obviously we're like any other company. We're evaluating this in real time and staying as close as we can to it. We have generational history in both the U.S. and Canada. When you think about our business overall. And so, I mean, I would point to what we've said before, which is that if you think across our businesses in the U.S. and Canada, generally where we brew beer, we source the materials from and brew in those countries. And so our exposure is certainly, more limited overall, but it's something we have to stay close on because it's ever evolving.
Yeah, and speaking of ever evolving, I mean, 2 centuries of brewing, that's a long time. Yeah. So how have things, changed most recently as far as the company? What are you looking ahead to, or what are you seeing? What are you excited about coming up?
Yeah, I mean, I think, well, we've been talking in this conversation about just the need to be flexible and evolving and engage with consumers where they are. We talk about our ambition is to be category first, really lead for driving the growth in the category. And that first way we talk about doing it is thinking about understanding the drinkers of today, but the drinkers of tomorrow. So we're obsessed, we're drinker obsessed. We're trying to understand what are the motivations, what are the things that are different, and what are the best ways to connect. And this landscape is evolving. It's evolving quickly. But that's why we think about our strategy to be a beverage company, to be a company that thinks about meeting the needs of consumers in any of those spaces where they are and finding the right thing to do it, whether it's evolving our programming of our core brands so that it feels like it really resonates and connects, or whether it's building new to the world innovation. We just launched a new to the world innovation that's bubble free. So it meets a functional need for a consumer. Yeah. So it feels like a refresher. So it meets a functional need for a consumer, but it also feels, like something that's on trend for that consumer as well. So that's the big opportunity for us, I think, is finding a way to evolve there.
Now, how do you evolve with that? You spoke about this before, the different generations. So if I'm sitting at a bar and I'm having a Blue Moon, but then someone else is having a different one, how do you connect those generations so that everyone is kind of along the same pace or, wanting the same thing? How do you connect the generations?
Yeah, well, I mean, at the risk of being charged for every time I say occasions, I'm going to just say it one more time. But think about what an occasion is, right? Yeah, it's right. It's all those moments where you think, who am I with? What are we doing? So I'm meeting with family, and there's generations of family there. Or I'm having a social occasion with people I don't necessarily know as well. The commonality is you're all there and you're there together. The difference is of what you find appropriate and for that moment. And so any of those things can have an impact, but we think what we're trying to do is find the understanding in the insights that surround those moments and then bring the products into that. So that the reality is if you're in that social occasion together with family, then that might mean something very specific for what you want, but it might mean something different for someone else. So it's really that understanding. And I think the difference is when you look across the occasions is the broad scope of occasions stays pretty close to the same. I mean, generally they're doing the same kind of things, relaxing at home and unwinding or going to a big celebration. The kind of products they chose is different, but the underlying sentiment is the same. And so if it's beyond just like thinking about the insights, I mean, it goes all the way down to how you reach them on the path to purchase, which we talked about with convenience, how you think about how to optimize how you reach them with media. So, I mean, there's a whole lot of layers to it, and there's a complexity that can feel like daunting, but there's a complexity that can feel like a big opportunity, which is just how are we as relevant as possible for them, and how does that move the category?
Now, what advice do you have for companies? Because you started this category, first idea. So for companies who are looking for that next idea, for their company, what advice do you have for them as far as, how did you come up with this, this whole thing?
Yeah, I mean, we've been on the category first mantra for a while, and so I think we're, certainly uniquely positioned for where we are as a business to be leaning in that way because we just the inherent differences that happen within beer. But I think maybe the advice is think more broadly about the capability discussion. So, I mean, capability can take on supply chain capabilities. That's a big part of our conversation every single day. Capabilities can be commercial capabilities. It can be digital capabilities. It can be category management or analytics. You guys already talked a little bit about AI. And so analytics plays a really big role in capabilities for any organization. And so be open to thinking about the capability conversation beyond just what happens maybe in some of the supply chain components, how it layers into commercial, and then where you're thinking about meeting the needs of the stakeholders in your value chain. So for us, that's because of the complexities of beer distributors, consumers, and our retail customers as well.
And do you find like technology kind of changing the way you do business as well?
Oh, absolutely. Yeah. I mean, across all of those things. I mean, I think from, like we talked about already, the way you reach people, but also the way you provide efficiency to a distributor, that is out there driving your products to shelf every day. How do we make their job really easy? And technology has a big role to play in that, especially in the interaction of us with them through retailers. How do I make it really easy for you to show up, deliver on the expectations of the customer, and provide better service?
All right. Jeff, thank you very much.
Thank you.
All right.
Appreciate it.
everyone. It's great to be here with you. So we've come to the midway point of our program. And Paul, I was wondering if you could give us a quick refresher on what Invesco QQQ is.
Sure. So I'm sure many of you have heard or have invested in QQQ in the past. Last week, your very own ETF expert, Eric Balchunas, referred to it as the eighth wonder of the world. And I think that has to come down to its performance and its very simplistic methodology. So Invesco QQQ replicates the NASDAQ 100 index, which invests in the 100 largest non-financial companies listed on the NASDAQ stock exchange. It market cap weights them, so very simple, very straightforward, even more simple and basic than the S&P 500, which has a committee approach to choosing the constituents. And really what we've seen through the years is that a lot of innovative companies have made their way into the NASDAQ 100 and therefore into QQQ, and really has become a coveted ETF to be a constituent in.
Yep. And simple is good. Innovation and performance, you made that connection. Tell us a little bit more.
Sure. So I definitely think there is a connection between a company's ability to innovate and the performance of their stock. And as Jeff alluded to, even a company in the beverage industry needs to be innovative in order to stay relevant. You know, within our world, though, we try to quantify that innovation. And the primary way that we do that is through research and development spending. And what we've seen through the years is that your average NASDAQ 100 company is spending about $15 billion a year on research and development. So to put that in more relative terms, your average S&P 500 company is spending about $10 billion a year on research and development, so about a 50% lift. What I find extremely interesting, though, is that if you take out those NASDAQ 100 companies from the S&P 500, that number drops down to only $1.5 billion. So you get a 10x multiplier on research and development spending there from these NASDAQ 100 companies. So I think what you see really from that connection, though, is that as companies spend more on research and development, as they innovate, you know, through the years, it's able to position them in a better place. What we've also seen, though, is that this research and development spend has led to stronger fundamental growth. And we all know that fundamentals is what drives price at the end of the day. So we've seen earnings, dividend growth, along with revenue growth, outpace that of the S&P 500 and the Russell 1000 growth. And you know, we've seen the strong performance that translate into strong performance within QQQ throughout the years.
It sounds like then there's really a culture of innovation in QQQ companies. Is that fair to say?
I definitely would say so. I think another way to look at it is that the companies within QQQ have a pedigree of innovating. And I really attribute that to the fantastic work that NASDAQ has done to attract new companies or companies that are going to be going public to list on their exchange. I mean, if you think about it, if you're a young executive, perhaps more technologically focused, doesn't have to be classified as a tech company, but more technologically focused, and you walk through the halls of NASDAQ market site and you see the pictures of, you know, Steve Jobs and Jeff Bezos. Mm-hmm. Do you want to be included in that era? Hopefully someday, of course you do. Yeah. So there definitely is a culture of innovation that, you know, really has been fostered through the research and development spending, along with the fantastic patent activity that we've seen from these companies.
Wonderful. Thank you very much, Paul.
Thank you.
Thank you so much for being here with us on obviously what's been a really busy market today for everyone.
Yep.
One of the main objectives of the Northwestern Endowment is to generate returns in excess of the spending. But at the same time, you want to do that by limiting volatility of the investment pool. In this environment, how do you do that, and what's keeping you up at night?
Great, thank you, and thank you for having me. It's nice to get away a little bit. It's interesting because to generate returns, we have to embrace volatility. But we try to manage volatility in a couple of ways. One is to have diverse sources of volatility, things that aren't correlated, so that the overall pool is less volatile than probably any individual or many of the individual components. The other thing we try to do is analyze the historical patterns in volatility, and obviously correlations change and they're not stable. So what keeps me up at night is the pace of change and the way that I think we may be entering a kind of regime shift in terms of markets, interest rates, inflation, globalization. I think I may have mentioned I started in Wall Street in 1989, and the Berlin Wall came down maybe a month after I started my job. So most of my career has been in a period of increasing globalization, mostly declining interest rates and mostly low inflation. So I think we're in a different world. And that means all the analysis we do on historical volatility and interest rates and the relationship between the economic cycle and inflation, we have to think about what's the right historical period to look at. So the geopolitical risk, which I think has higher than I really can remember, and it's not just the last 6 weeks, it's really been, I think, increasing. More regulation, and that's true in many countries, is putting more sand in the gears and making things a little bit more unpredictable, and that definitely keeps me up at night.
And thinking about that geopolitical risk, regulatory risk, and the political influence that you see in markets these days, how is that influencing your asset allocation? Is there anything that you changed or you were planning to change in terms of the endowment's asset allocation?
Yeah, so there's probably 3 answers to that. We are still committed to international diversification. That actually hasn't been a great strategy for the last decade. I mean, there were probably 7 stocks, maybe QQQ is all you really needed to own. But but I think we are of the view that if we're moving into a world of several fortresses, Fortress US, maybe Fortress Europe, maybe Fortress Asia, China, there'll probably be winners in every fortress. And so as long as we are legally able to invest globally, we will continue to invest globally. So that's one thing that we're not going to change. I do believe that we have decided to have a slightly higher allocation to cash. And that is for a couple of reasons, one of which I think we'll get to later, but one is just more volatility, markets moving sharply. We also have a big payout rate of 5% a year, which is real. So we want the option value of cash. We want the liquidity. So I'm not talking about huge amounts, but I'm saying going from, say, a 4 to 5% cash and treasury allocation to more like 6 or 7. So this is not cataclysmic. But I think in some ways what we see happening is higher rates and potentially lower overall equity market returns, kind of a flatter risk curve. So I think having a little bit more dry powder makes sense. And that gets at the third point, which is I believe that to largely increase tariffs, increase regulation. I'm just sorry, I'm old-fashioned. I think that decreases profit margins and return on equity broadly. It doesn't mean there won't be winners and losers, but so I see the risk that equity returns in the aggregate, return on equity is lower. And so if you have higher rates, lower equity returns, I think that implies slightly different allocations. But as you said, we got to get that 8-9%, so we are not going to get rid of equities.
Fair enough. And then thinking about it's been really, really hard for money managers to beat the S&P 500 in the past, in the recent years. And, you obviously joked about, all you have to hold is QQQ, I guess. But my question to you is, one of the things we've started seeing is that there is a huge dispersion now in the sub-indices, and what does that really mean, and what opportunities does that present? When Northwestern is thinking about that dispersion we're seeing in the sub-indices performing so differently one from the other now, are there opportunities that you see? Do you see like more an opportunity to like pick more individual stock pickers, or?
Yeah. So we actually like this dispersion, and we had never given up on active management. I think, again, it was looking like a tough slog, but I believe in the long run, we are fiduciaries. We want to pick and invest in the best companies, and in the long run, I think those will generate the highest returns. I think also, a higher interest rate environment is a higher cost of capital. A higher cost of capital rewards businesses that allocate capital well and generate a higher return on that capital. So I think to some extent, when you have zero interest rates or close to, or even negative real interest rates, the rising tide lifts all boats. And it makes it very hard to short, and it makes it frankly kind of hard to get punished if you pick bad companies. Bad companies can live for a lot longer. So I think that for a lot of reasons, we do believe in the fundamental stock picker model. I think we have a very long time horizon. We're not trying to beat the market by a week or a month. We're trying to generate returns over decades. And because I think the other piece of this is the rise of algorithmic trading and quantitative trading and passive, all together kind of are the forces that make momentum work and are a little bit against the fundamental stock picker. Those are real. Those are not going to go away. But I think they tend to be shorter term in their impact. And I think what we really look for is money managers who have concentrated portfolios, 10, 15 stocks, who also have, and this is a little crazy, but we actually like longer lockups because I want them to have a time horizon. Even if they're trading in liquid markets, I want them to be thinking on a 3 to 5 year. If I want the guy that's day trading, it's probably a highly quantitative strategy. But for the real business owners, I want them to think like business owners.
And how are you thinking about it? Are you allocating more of the money to individual stock pickers, or?
Yeah, I would say we, over the last few years, probably the last 5 years, have increased our long-short allocation. Again, that gets easier when rates are, it's very expensive to short, and it's good to have a rebate. So we like that, but we also like the failure potential that I think gets higher when you have higher cost of capital. So we've probably doubled our allocation to long-short managers, which I think of as the ultimate stock picker. And we've also moved, we always have had a lot of private equity, which is different question, and venture, but within the public equity portfolio also, we have begun to move towards funds that really are willing to own 15 stocks rather than 30 to 50. And again, that's because we have several of them. I'm not saying individuals should go out and do that, but I think as an endowment with 20 public managers, if they all have 50 stocks, then you're basically running an index fund. So we are looking for high conviction stock pickers.
And for universities, of course, the elephant in the room right now is the endowment tax and that increase. Can you tell us a little bit your view on what that means for Northwestern and how Northwestern is preparing for it?
Yeah, so it seems quite likely that the endowment tax will be increased, which I will say I think is a little sad, just to the innovation of the QQQ, and this country has a great history of innovation, some of which has been because we have the greatest research universities in the world. And I feel cutting the resources available to our greatest research institutions, in my view, is not really that smart. But I get it, and it's coming. So it's not above my pay grade to opine on that. It will be a significant change in that we have to start thinking a little like taxable investors. The tax right now is on realized gains. We have to realize gains. We spend out of it's a $14 billion endowment. We harvest $700 million a year that we pay out to the university, a little more than that. So I will have to have liquidity. I'm going to have to generate liquidity. We usually, in the past, have always generated from whatever was doing the best and where we had the liquidity. And we now will probably take into account the tax implication as well, which is, lots of people do that all the time. We didn't have to do that. I also think we will probably have to have a little more liquidity, particularly. So again, part of that increase in cash is just recognizing that there's some non-zero chance that the pay rate has to go up because some of it's either going to come out of the university's budget or it's going to come out of the endowment's payout. It might be a little bit in between. So we need to be prepared for that. And I think, it's interesting because we have had long time horizon advantage. I do think privates have been an important source of that. You don't control your distribution typically, although we might start asking for stock instead of cash distributions. It's a little bit technical, but I think we're probably going to need more liquidity also. So it's a tension because we have to, we probably want to drive towards higher returns, but we'll probably need more liquidity as well.
And we're seeing that at the same time as we're seeing universities face some federal cuts. Can you talk a little bit about Northwestern's experience and how do you prepare for that? What consequences does it have for an endowment and the university as a whole?
Yeah, I think the important thing is as an endowment manager, we manage money on behalf of the university. So everything we do is in service of the mission of the university. It's a little different than just running money. So we have to think about how the university will manage declining resources. That is, and again, there's three different places. One is direct cuts in research funding, so like the NIH capping. And I will just take a moment to say indirect costs are not exactly just overhead. It's typically facilities, equipment. Most, for Northwestern, like many universities, has about 40% across all grants. So capping grants at 15, part of what costs money in indirect costs is if you have a really expensive microscope and many labs use it, it doesn't get allocated to one research project. That's a shared resource. I wouldn't call that overhead. It is, but it's fixed costs that are generally shared. So I think these are real cuts, and they will result in potentially less resources, almost certainly less resources available for research budgets. And the tax will be more general budget, which, of course, the endowment supports financial aid. It actually keeps tuition lower. A lot of people are confused and think tuition dollars go in the endowment. The endowment has no tuition dollars in it. It's because of the endowment that tuitions actually aren't higher, and that we have the financial aid resources to have, for instance, no loans and no limitation on student access at Northwestern. So those things are, at risk. But so I think I worry about the impact in the U.S. for innovation. Even the internet, grew out of Defense Department spending, way back. I know I am visited by a delegation periodically from Japan, where the Japanese government has just put $70 billion into a fund, the government, to fund research universities in Japan, because they noted that their competitiveness in terms of innovation was slipping. So I just, we don't have a biblical right to innovation, and most people in this room are global. But I think as a country, we profited from having great universities, and they're great. They'll stay great, but they're going to have to figure out how to fund themselves.
You talked a little bit about, also thinking more closely on how you realize gains. And then at this point, we do have a question coming in from the audience. Last year was a record-breaking year for U.S. ETFs. So how are you thinking about ETF, the pros and cons as we move through 2025?
Yeah, so I love ETFs, especially as a person, because they don't distribute gains, which is great. I do think we have thought a lot about, and probably will continue to have, the need for liquidity. That's a very nice solution for us. So we'll probably have, continue to have stock pickers. as I said, I like to pick people and give them capital with certainty, so they know they have 3 or 5 years. So to balance that, I probably want something very liquid, and where I don't have to, I can control the tax implications. So I think there's a role even for institutions with these instruments.
Mm-hmm. And we've got another question coming in from the audience. Amy, can you please talk about the details of private equity allocation and some themes around triggers from PE allocation?
Sure. So we try really hard to be steady Eddie in private equity and venture and any private asset class. But there are some, triggers. I think one thing that happens with private equity and public equity is the public markets adjust way more. So, if you're trying to manage to say a 20% allocation to private equity and then the public markets drop 20%, like suddenly your private equity doesn't drop, you've got more of it. So we try to ride through those cycles. I think, broadly speaking, this is probably a decent time to be making commitments, but we have seen slower return of capital, obviously less good returns in the last couple of years. So that's sort of, I think that means actually our public equity is high now relative to our private equity. But we try to be steady. I think the worst mistakes institutions make are getting out of, I can remember nobody put money in venture in 2011, 2012, 2013. It turned out to be the best, great vintage years. So it's very dangerous, I think, in these super long duration asset classes to hit the brakes too hard, or frankly, hit the accelerator too hard when it looks good. I'm not sure if I answered that question. It disappeared, but I'm just trying to remember what it said. But there are. I think it's important to stay steady, even when. But overall, I would submit we'll probably have to have a little less allocation to privates, given the amount of tax and uncertainty.
Yeah, I do think you answered that question.
Okay,
so last but not least, let's talk a little bit about AI and how is that changing the way you do your job and how are you using it to make investment decisions if you're using it at all?
Yeah, so I would say there are two things. One is we've got to understand how other people are using it. And I think there are managers who are deeply using AI. Of course, they've been using AI, the quantitative AI, forever. So, I mean, not forever, but for a long time. The large language model in revolution is a little newer. But we still see, very interesting applications. And clearly, there are franchises that have invested enormous amounts of money into their technical and computing capability. We like to understand that. We feel like we need to understand that. For ourselves, what we're finding is similar to what an earlier panelist said. There's a lot of rote work and reading that we can really start to push to have AI help with. Legal documents being an obvious example, but also just, when I look at a new manager, I like to read every letter they've written since they went into business and then kind of make themes. And I used to go through and highlight, when did they sell the stock? I think it's kind of nice to have AI summarize, read all these letters and summarize what they bought and sold over the last 10 years. That's kind of makes life easier on the young people. They don't have to do that.
And are there moments where you say, like, the bots are already helping us make decisions, invest here or there?
I think they're helping us digest information. One thing about endowments, we're pretty unconstrained. We could invest almost anywhere, and there's just so much information. So I think they're not really making decisions for us yet, but they're helping us wade through more information and be more productive.
Mm-hmm. And as you think about 2025, what industries are looking particularly attractive this year and maybe in a 5-year horizon?
Yeah, we've been doing a lot in biotech. It's been kind of an unloved sector, and in spite of the cuts in funding, I still think there's a lot of upside there. We also, China got really cheap. We put some extra allocation there. That's politically very difficult to handicap, but the PE multiples look very attractive. We're seeing a lot of interesting stuff in venture, so it's a kind of an interesting moment. We're seeing a lot of young firms starting, many with great pedigrees from very well-known franchises, so we're spending time on that. I think credit is still interesting. I actually was worried about private credit with the increase in rates, and we haven't really seen a default cycle, and kind of would have expected one by now. So I want to be careful, but I think as we move through into potentially, we do have worries about a recession. I think we'll see default rates. I think that's a space we'll want to keep an eye on for an entry point.
And in terms of recession, how quickly or could that be coming?
That's so hard to handicap, but I do feel there are a lot of headwinds to the economy right now. Fiscal contraction, sticky rates, obviously the stock market's not doing great. And I think the tariffs create a lot of uncertainty for businesses who are trying to figure out how to invest. So I see sort of fiscal contraction, potentially business spending contraction, consumers probably a little nervous. And I think it's going to be hard for that. The Fed can lower rates. That doesn't necessarily drop the 10-year, right? So I think you could see curve steepening. And so I think, to me, it's a more than 50-50 this year.
Amy, thank you so much for being here.
Yeah. Thanks.
Everybody, this is an exciting session. I have some cash lying around, so I'm hoping I get an answer of what to do after this. To start off with, my name is Anurag Rana. I'm a technology analyst with Bloomberg Intelligence. I spend my daytime looking at technology companies from Apple to Microsoft, AWS, and then the whole plethora of them. Let's start with an introduction of our guest, please, Anastasia.
Sure. Anastasia Amoroso, I'm the Chief Investment Strategist at iCapital. For those who maybe are not familiar with iCapital, we're an alternatives fintech company, a marketplace for alternatives. So in my role, I spend time thinking about the macro universe out there, growth, inflation, risk, central bank policy, fiscal policy, and what impact does this have on various alternatives asset classes, private equity, private credit, real estate, and more. We do also have a structured investments business, so I can't avoid public markets either. So I'm sure we'll talk about that as well.
Good evening, everyone. Thanks for having me this evening. I'm Chris Roth. I'm the Chief Investment Officer for global fixed income for Northern Trust Asset Management. Many of you may well know Northern for its 135 years. Here headquartered in Chicago, we manage $1.3 trillion in assets under management within fixed income, $160 billion, and including liquidity, $475 billion.
Matt Stuckey, I'm Chief Portfolio Manager for Equities for Northwestern Mutual's Wealth Management Company, our retail offering. We just crossed $335 billion of assets under management, and given the volatility of the stock market, I think we're looking forward to the conversation today.
It's fun to see these so many billions and trillions are just flowing through right now. So, one of the first important questions right now is when you walk into a year, everybody has an investment outlook. So let's start with that. A common question for all of you. What was your investment outlook when you started in 2025, and has anything changed since then?
I'm happy to start. We titled our investment outlook for the year of solid underpinnings and plenty of wild cards. And I sort of stand by that right now. And, the solid underpinnings that we were talking about is the U.S. consumer that finished the year of 2024 on solid footing and seemed like was heading into this year on solid footing as well. I personally would argue that despite the consumer confidence numbers that we're seeing, we're actually still seeing spending growth running 3 or 4% year over year. So I don't see a massive problem with that solid underpinning. We talked about the solid underpinning of deregulation, and maybe we have to wait to really see, the fruits of that labor. But then there's also one that I'm still equally encouraged about, which is the growth in productivity that we've actually seen in this economy. And if you think about the last 5 years, U.S. productivity growth has increased by 2.1 percentage points on average, which is well above what we saw in the prior 5 years, where we saw 1.4% productivity growth increase. So whether it's COVID, whether it's AI investments, but I was encouraged by productivity growth also giving this economy resilience. Now, none of this has changed, but what we also said in our outlook is that while those 3 or 4 factors that I outlined are positive for risk assets, what's ultimately going to determine the outlook is the wild cards, which is taxes, which is tariffs, which is fiscal policy, the pace of rates, and also, by the way, big tech regulation. And so when we sit here today, it seems like the wild cards are certainly whipsawing the markets around and certainly determining the outcomes. I would agree as kind of a bottom line with Amy that, I think this market is still investable. I think this market can still, for the full year 2025, generate positive returns in my view, because we have 13% earnings growth. We didn't wipe all of that out. Maybe we shaved off 1% or 2%, maybe it's 3 or 4, but we certainly didn't wipe all that out. But it is a market that is more difficult. The upside is likely more capped, and therefore we have to be more discerning investors.
Chris, what about you?
We go through two processes in parallel as we come towards the beginning of the year. One is our 10-year capital market assumptions, where we're trying to think big picture, long term, more as a buy and hold investor, and at the same time trying to think tactically about the year ahead with a base case scenario and two alternative or risk scenarios. And the base case scenario, for many of the reasons that Anastasia put forward, we're very much towards the fact that we are in a mid-cycle adjustment. The economy is slowing from a period of intensely rapid growth, followed by relatively intense restraint, and that as the Fed began to take its foot off the brakes, that the economy would stabilize at some area near growth in both, or near trend in both growth and inflation. Many people call that soft landing. It could be that if we hit soft landing in 2025, it will be Goldilocks, and so that's where we started the year. While there's a lot of volatility in the market, we're still holding to that as the baseline.
Yeah, I would agree with that, Chris. We started this year with the view of to be a little bit more defensive, just given the starting point of valuations. And as a reflection of that, we looked at the investment-grade credit markets, and those were signaling kind of 25-year tights in terms of the compensation you would get for absorbing that credit risk. And that translates into high equity valuations. On a go-forward basis, that means your upside, to your point, Anastasia, is likely capped, probably more likely reflected in terms of what ultimate earnings growth you get if nothing bad happens in the economy. That forces that multiple lower for spreads to widen out. We are seeing some of those kind of wild cards come into the marketplace, causing uncertainties to move higher. And with that, we think investors are best served to really embrace diversification, whether that's here in the United States and smaller and mid-cap asset classes or outside the United States, areas that haven't kept up with the QQQs as well as the U.S. large-cap asset class. So we're sticking with that posture as it is now. We want to have a lot of embedded hedges within our portfolios for our clients. And that's how we're going to continue to navigate this until we get some more certainty.
Matt, we were discussing this a little earlier. The 1Q GDP numbers are trying to be revised downwards or trending downwards. And, does that change your outlook for a healthy growth for the full year? Or are you still seeing, some kind of improvement or a continuation of a good economic growth?
I think that's started to catch some investors off guard. If you looked at where we ended the year, the consumer spending was at a high note, year-on-year growth of north of 4%. But that started to pull back a little bit. You saw the January retail sales slip into negative territory. That could be weather-related. That could be wildfire-related out in Los Angeles, unfortunately. But what I think is also a risk is the policy uncertainty. Since the October levels, policy uncertainty has 4x'd since then. And those types of shocks can cause a pullback in consumer and business spending. Whether or not that's translating into GDP estimates via the Atlanta Fed that's pulled lower or not, we'll wait and see. But it is early in the quarter still from a data perspective, and so those numbers can adjust around. But ultimately, also within the trade component of GDP, that's really pulling the estimate down for this first quarter. And what's interesting, if you kind of read through some of the Atlanta Fed data, what's really driving 60% of that gap out in terms of the trade deficit is gold imports. Gold imports don't have much of an impact on the economy near term. And so if you adjust for that, if you adjust for some of the strong labor numbers that we saw last Friday, we're actually slightly in positive territory, which is encouraging.
So Anastasia, you talked about consumer spending slowdown.
Yeah.
I mean, in the last 3 weeks also, we're just seeing, negative pre-announcements from Walmart, and Amazon's just been, declining. Do you see any structural change in that thesis, or you think it'll just adjust itself back?
I don't, not yet. And, to Matt's point, we had consumer spending that was incredibly robust to finish the fourth quarter of last year, running around 4%. And I think some of the slowness that we're seeing today is the give back of the fourth quarter that we've had. You also can think about consumer confidence, and on the surface, the slump that we've seen in consumer confidence, maybe it tells you, well, consumers are not going to spend as much. Well, maybe. That's a question mark for me, because if you look at consumer confidence, it's really been in this wide but depressed band since about 2022. And despite that, not just seasonal, but perpetual depression that we've had, consumers continue to spend. So I don't necessarily see the GDP report or the consumer confidence or maybe even some of the guidance from retailers telling me something new. When I would start to worry is when if the labor market starts to crack. And, when the private side, I don't really think we're there yet. We had a strong payrolls report. We still have profit margins that are near record highs for now. So I think all of that is intact. But I guess on the margin, I do worry about what does DOGE mean for the labor market, and not just on the federal level, but what does DOGE mean on the labor market on a municipality, on a local level. I had dinner with somebody last night who is a local mayor for a municipality in Florida, and she was telling me how you do a project and you expect that a part of that project is going to get reimbursed by federal funds. Well, there is a huge question mark about not just that project, but many others. And do you go and pursue it, even though you're not sure whether you're going to get the funding from the federal government or not? Or do you halt it? Do you stop it? So, so I worry that will over time start to weigh on the consumer. So when we're picking spots to invest, probably consumer discretionary names is not going to be top of the list there.
Fair. Chris, one of the things that has concerned me, even though I'm a tech investor, is inflation and tariff because of tariffs and what the impact of that would be on rates. I care about it because the discount value of future cash flows for tech companies is highly dependent on the interest rates. What are you telling your clients with this risk of inflation coming back back in the system?
I think there are a couple of points that are worth making. One is we are in a period of intense tariff uncertainty. We saw that today in terms of potential tariffs that could have come in place and did not come in place. And so we don't know where we're going to go. Our best estimate is that the average tariff rate, which has probably been in the 2 to 4% range over recent decades, moves to the upper single digits. We probably would have said 6 or 7%. Now we might say kind of closer to 10%. One is to remember that in many ways tariffs are taxes, and it's a question of who the tax is on. Is it on a foreign government, which is clearly the objective, or is it actually therefore a tax on the company that is absorbing or producing the good, or it on the end consumer? And then there's also the element of we all tend to say all things held equal, ceteris paribus, but they're not. Things change. There are substitution effects that happen. There are impacts that happen in currency markets. We've seen that really dramatically in movements in currencies of our trading partners. And so while we've had a period of time where the dollar, the DXY, has been off a lot, the trade-weighted dollar actually tells a very different story. So our view would be that we get a bump that is an inflationary bump that comes through. If core PCE is around 2.6% today, maybe we bump towards the high 2s before we begin a trend back down towards the Fed's long-term target.
And it says the same thing. Do you think that inflation gets passed on to the consumer? I mean, I'm extremely worried about Apple and the iPhone cost going up. I cover Apple, so part of my worry is both on the margin side and the unit shipment side. But do you think the consumer will eat that profit, or the companies will have to eat that up?
Yeah, I think it is way too early to tell. But to your point, you're not alone about worrying the price of an iPhone or anything else, because when you look at the same consumer surveys, you see that the 1-year forward inflation expectations have really spiked, now approaching 4 or 5 or even 6%, depending on the survey that you look at. I think it is far too early to tell what's actually going to be the result of the tariffs. And first of all, there are offsets. To the point, Chris, you were talking about, is it possible that the foreign government decides to eat some of that cost? Is it possible that the dollar appreciates so much that there's not actually an impact to the U.S. consumer? Is it possible that the company doesn't decide to pass on the full higher cost of goods sold to the consumer. All of these things are still within the realm of possibility. Oh, and by the way, is it also possible that all this is a negotiation tactic, and as a result, tariffs might actually get dropped on both sides? So we just don't know. But I think there's something else that's interesting. Maybe that's part of the strategy. As you might have noticed, President Trump and Secretary Bessent are not overly concerned about the stock market. But you know what they're really concerned about is the level of yields. And another consensus view going into the year is that yields are going to continue to move higher, and the Fed is not going to cut rates. But is there a chance that this administration is using the tariff ping pong and this policy uncertainty to actually drive the level of yields down? It possibly, by the way, this is a total speculation on my part, and possibly force Fed Chair Powell into cutting interest rates. And so if that's the situation that you actually end up with, then maybe the slower economy, this fiscal restraint, does more to reduce inflation than what tariffs could have done otherwise. So I think it's far too early to tell. So
I was just going to, first of all, your questions were rhetorical, but the answers are yes, 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 and yes.
I forgot the questions.
They're all possible. Yeah. I think the other thing is that Treasury Secretary Bessent said we need detox, if I recall the word correctly. We might need a spa or a sauna or a cool down. The idea that the rates were going to go to 5%, we had an economy that was booming. It was hitting on all cylinders. We had year over year, fourth quarter earnings growth 18%. And so in many ways, these slowdowns, whether they are engineered or they are a result, are actually probably very healthy for the broader economy.
So Chris, just on that, what's happening to credit quality? What are you telling your investors in terms of which part of the curve they invest in at this point?
Well, if I move down to high yield to get to kind of where credit is really credit and where you worry about default risks, there's a lot of really great news. The rise of the private credit market, Amy Falls spoke about this earlier, has been an enduring rather than something that might have been seen as more transitory. That has actually done a lot to support credit quality or capital available for the high yield market overall. If you think about private credit as almost kind of small cap leverage finance, it's pulled companies out of the leverage loan market. The leverage loan market has pulled companies out of the high yield market. The high yield market has become larger cap. Companies have become stronger. They have better coverage ratios, lower debt levels. And the percentage of companies that are the highest rated has moved up to record highs. So now the majority of companies in the high yield market are double B rated, and the lowest rated companies, triple C, are half of what they were post GFC. So there's a big positive story to tell there. Obviously, we're in a period of time where we have tumult, and so nothing's immune from that. But I think longer term, the secular story is really strong.
Sounds good, Matt. Let's talk about my favorite topic, AI. I spend more time on that than any other word in the last 2.5 years. What's your take on this entire CapEx boom bust training inference? Where do you stand on that, and how do you advise your clients which way to look?
Well, I think a lot of investors are responding to some of the volatility we're seeing in the AI stocks so far this year. They've definitely ridden up the most in terms of 2024 and momentum there, and that's come off here in this year. And the question is whether or not is that a head fake or is that the start of something more pernicious? I think really if you want to look at the sustainability of this cycle, you have to start and end with the CapEx announcements and estimates for the biggest spenders in the space. So the 5 biggest are Amazon, Google, Meta, Microsoft, as well as Oracle. And just take a step back and think of where the CapEx number was 5 years ago in 2019. It was a little over $50 billion. This year it's around $317 billion. So roughly a 30% CAGR. But what's the most important number in that is how those expectations for 2025 have evolved in just 2.5 months into this year. They've been revised higher by 20%. So I don't see this spending slowing down this year. The question is, in 2026 and beyond, the sustainability of that profile. It's inevitable that at some point there will be a correction in terms of CapEx spending as we rationalize some of this spending. No tech-level investment doesn't go without fits and starts, but in terms of the near-term environment, it continues to be robust.
Cesar, what about you? This is again a favorite topic for the a lot of investors you talk to.
Absolutely. I mean, look, artificial intelligence obviously is the biggest commercial opportunity that we have today, and it's probably the biggest opportunity we have as investors. But I think the way you invest in artificial intelligence naturally has to evolve as we progress in that cycle. And it makes sense that in the initial stages, you invest in the infrastructure layer, you invest in the semiconductors that there's insatiable demand for. But as we progress, and if we actually look at the total addressable market for artificial intelligence, 88% of that is software. So yes, you've got some semis, yes, you've got some services, but actually most of the payoff of artificial intelligence is going to come from software companies. So, the question that I think is in front of investors right now is, now that we've had this pullback in AI names, which spots do you buy? Do you go to the same Mag 7 stocks? I'm not so sure. Because first of all, the Mag 7 stocks, they're not immune from the potential slowdown in consumer demand that we talked about. They're not immune from potential, restrictions and foreign revenue exposure. And to Matt's point, they've ratcheted up CapEx, but you look at a company like Microsoft, and that's your world. But you look at a company like Microsoft, and you have not seen the top line growth that's corresponding to that. So I have a question mark whether you go back to the Mag 7. But if you look at some of the software companies in artificial intelligence, you've got multiples that are still significantly lower than where they were at the peak of COVID. You've got revenue growth that I would probably argue is stickier, maybe a better profile in this environment. If you think about semiconductors, they're highly cyclical. If you think about software, higher margins, and those margins don't tend to move quite as much depending on what kind of environment you're in. So I actually think software can be, both the most opportunistic, but maybe also the more defensive part of the AI ecosystem. And of course, software has lower exposure in terms of foreign revenues as well. So I think the mindset about how you invest in artificial intelligence has to evolve.
I would agree with that, Anastasia. And just to kind of put a point on it, the software companies are going to be designing the products that they ultimately sell out to the broader economy to harness the power of AI to bring about those efficiencies to companies that are primarily services-based, information-based, knowledge-based, and can use those tools that software companies create through AI-powered technology to increase productivity. That's ultimately what drives sustainability in the AI space, in my mind.
As a software analyst, I'm so happy. Chris, we are almost running out of time. Let's talk a little bit about liquidity in the bond market and spreads. I mean, have anything changed for you dramatically in the last, let's say 3 weeks or 2 weeks or 3 weeks?
We haven't seen it in the last 2 or 3 weeks. But I will say something that I've kind of banged on about is this idea that we're going through a secular change in liquidity in the corporate bond market. If you're old enough, there was a time when equities traded in eighths and quarters, not in fractions of cents. Now we lived in that world in investment grade and high yield for many, many years. We're moving to a world where electronification and alternate pools of capital are bringing us to systematically tighter bid-offer spreads. If you think about investment grade, if you bought a bond and it had a spread of 100 basis points, you probably only need to get paid a small portion, 10 or 20 basis points for default loss. All the rest of it paid you for liquidity. If liquidity improves, if transaction costs narrow, ultimately over time, that's more of a secular trend. Not to negate anything that Matt said earlier, but I think it's a countervailing force that keeps high quality credit valuable for investors.
Great. Thank you so much. We're out of time. I would have kept on going and wanted to get more opinion from all of you. Thank you so much.
Thank you.
Thank you.
Thank you, everybody. That does it for the content portion of our event today. Thank you for all your questions, too, that came across, for sending those in for us for today. I also like to thank our sponsor, Invesco QQQ. Without them, we wouldn't have these conversations today. So thank you for them. If you would like to find out more information, just head to our Bloomberg Live page, and you can find out, click the Resources tab, and you can find out some more information there as well. And if you heard something for today that you didn't write down and you're trying to remember, you can go back and view this on demand. So head over to BloombergLive.com and you can watch it on demand there. So thank you again, everyone, for all your questions and everything. Thank you for everyone at home. That concludes us for today. Enjoy some networking and some cocktails. Thank you very much.